Nigeria's interest rates just took a quiet turn that could reshape how money flows through the entire economy. And this is the part most people miss. Even though the headline policy rate stayed the same, the real action happened in the corridor around it, where banks actually feel policy on a day-to-day basis. Nigeria's financial markets have reacted strongly to the Central Bank of Nigeria's latest decision to adjust the monetary policy corridor, with yields dropping across both the money market and the bond market. In simple terms, the return investors earn on short-term and long-term Naira instruments has generally moved lower, reflecting a shift in how the central bank wants money to move through the system. But here's where it gets controversial. Some see this as the first quiet step toward easing, even though the official interest rate has not changed. What changed in CBN policy? The Monetary Policy Committee, MPC, kept the monetary policy rate, MPR, steady at 27%, so on the surface it looked like a status quo decision. Beneath the surface, however, the MPC made a notable change by narrowing and tilting the asymmetric corridor from plus 250/250 basis points to plus 50/450 basis points around the MPR. That sounds technical, but it simply means the central bank has changed how attractive it is for banks to either park cash with it or borrow from it. This new corridor setting effectively reduced the Standing Deposit Facility (SDF) rate, the rate at which banks can leave excess funds with the CBN, from 24.5% to 22.5%. At the same time, it pushed up the effective cost of borrowing from the central bank through the Standing Lending Facility, SLF, from 29.5% down slightly to 27.5%, but with a structure that makes reliance on that borrowing window less attractive overall. The net effect is clear. There is less reward for simply dumping money at the CBN and more subtle pressure on banks to push funds into the broader economy instead. Market commentators interpret this corridor tweak as a signal of a mild shift toward easing, even though the formal stance still looks tight on paper. The adjustment encourages more liquidity to circulate through the banking system and into financial markets, while preserving the appearance of a high benchmark rate to maintain inflation-fighting credibility. Is this smart, targeted fine-tuning, or a risky halfway measure that could confuse signals to investors? Money market, liquidity surge and falling rates. Right after the policy announcement, money market rates responded quickly, reflecting increased liquidity in the banking system. The overnight O/N rate dropped sharply by 198 basis points to 22.69%, showing that very short-term borrowing between banks became meaningfully cheaper. The open repo (OPR) rate, another key interbank rate, stayed broadly steady at 22.5%, but overall conditions clearly loosened compared to previous sessions. Shorter and medium-term interbank tenors also saw notable declines, signaling that the expectation of easier liquidity is not just a one-day story. The 1-month, 3-month, and 6-month interbank rates fell by 169, 157, and 187 basis points respectively, indicating that banks are now pricing in lower funding costs over the near term. For beginners, think of this as the interest thermometer for banks starting to cool down, which can eventually flow through to businesses and, with a lag, possibly to consumers. Market dealers largely attribute this drop in interbank rates to two key forces. First is the corridor shift itself, which discourages banks from simply warehousing cash at the CBN for an easy, risk-free return. Second is the boost from a roughly 360 billion Nigerian Nairas OMO, open market operation, maturity, which injected additional liquidity into the system as earlier central bank bills matured and cash flowed back to investors. Put together, these factors created a mini wave of excess liquidity looking for a home, naturally pushing down short-term rates. Treasury bills, modest but telling moves. The secondary market for Nigerian treasury bills, (T-bills), also reacted, although the moves were more muted than in the interbank market. Yields on short-dated T-bills compressed further, with the 1 month, 3 months, 6 months, and 12-month maturities declining by around 2, 10, 11, and 1 basis points respectively. These are relatively small steps, but they confirm the direction of travel. Returns on short-term government paper are edging lower. Despite this softening at specific points, the average yield on T-bills remained essentially flat at 16.85%. That plateau suggests investors are still cautious and are not yet ready to aggressively reprice all maturities lower, likely due to lingering concerns about inflation, forex risks, and broader macroeconomic uncertainty. In other words, the market is acknowledging the CBN's slight pivot, but it is not fully buying into an aggressive easing story just yet. This tension between modest yield compression and a still elevated average yield captures the mood well, cautious optimism layered over a defensive posture. Should policymakers interpret this as a green light to ease further, or a warning that credibility is still being tested? FGN bonds and Eurobonds, signaling confidence. On the government bond side, yields on Federal Government of Nigeria, FGN, bonds dipped slightly, with average yields easing by about 1 basis point to 15.47%. Though small in magnitude, the move reflects a combination of strong local demand, improved system liquidity, and growing expectations that the central bank may be inching toward a more supportive, growth-friendly policy mix over time. Investors appear to be positioning for the possibility that, if inflation continues to cool and the naira remains relatively stable, there may be room for further yield moderation. This encourages some investors to lock in current high yields before they potentially move lower, reinforcing demand for FGN bonds. Over time, if this trend continues, the government's cost of borrowing in local currency could gradually decline, easing pressure on fiscal financing. Nigerian Eurobonds, sovereign bonds denominated in foreign currency and traded internationally, also participated in the rally. Average Eurobond yields fell by about 11 basis points to around 7.56%, suggesting that foreign investors are responding positively to signals of better macroeconomic coordination and a slightly more accommodative domestic monetary backdrop. When international investors accept lower yields, it is often a sign that they perceive reduced risk or improved prospects relative to the recent past. How experts interpret the corridor move. Although the MPR has now been held at 27% for 2 straight meetings, many analysts view the corridor adjustment as a form of technical or stealth easing. It relaxes financial conditions and supports credit creation without formally cutting the headline policy rate, which could have sent a louder, potentially riskier signal in an environment where inflation is still elevated. Market participants describe the corridor tweak as a liquidity cue. By lowering the SDF rate, the CBN has reduced the reward banks receive for passively placing excess funds at the central bank. This encourages banks to put more money to work in the interbank market, government securities, or real economy lending. At the same time, maintaining a relatively high cost of borrowing from the CBN nudges banks to manage their own liquidity more carefully instead of relying too heavily on the central bank as a backstop. Some economists describe this as accommodation under the hood. Outwardly, the stance remains disinflationary, but internally the system gains flexibility to ease liquidity pressures where needed. The intent appears to be to support credit growth and economic activity while still keeping a firm grip on inflation expectations. But here's where it gets controversial. Does this dual signal help strike a delicate balance, or does it blur the policy message and create uncertainty for businesses and households? The inflation backdrop, more breathing room. This policy fine-tuning is happening against a more favorable inflation backdrop than earlier in the year. Headline inflation eased to 16.05% in October 2025, marking the 3rd month in a row of slowing price increases. This downward trend has been supported by a stronger naira, relatively stable fuel prices, and improved food supply conditions, all of which help ease pressure on household budgets. With inflation gradually moderating, though still high by global standards,